Every single day, forces you've never heard of are moving your money. The Fed, AI, geopolitics, currency wars. Most people only see the headlines, but they never really understand the noise beneath them. And honestly, that's exactly what MacroSignal is for. Welcome to today's explainer. We're putting on our forensic accounting hats today to follow the money. And guys, I mean a truly historic amount of money. Just look at this number, $602 billion. According to credit sites, that is the staggering 2026 infrastructure projection for just the top 5 hyperscalers. We're talking Amazon, Microsoft, Alphabet, Meta, and Oracle. That represents a massive 36% year-over-year jump. And frankly, some estimates say it could go even higher. Fortune recently calculated that the 4 largest hyperscalers alone might actually approach a combined $700 billion. We are literally watching the largest deployment of capital into a single technology in human history. So, here's the roadmap for today's Follow the Money audit. We'll quickly cover this $600 billion CapEx boom, big tech-specific AI bets, exactly where this money is going, how they are financing this massive debt wave, and finally, the systemic risk ahead. All right, kicking things off with part 1, the $600 billion CapEx boom. To really grasp the sheer scale of what's happening here, we first have to talk about capital intensity. It's just a fancy finance term for the percentage of a company's revenue that gets spent on capital expenditures. Now, historically, the norm for tech companies was incredibly lean, roughly 10 to 30%. They built software, they enjoyed sky-high margins, and they essentially printed cash. But look at the projection for the 2026 AI era. We are suddenly seeing capital intensities of 45 to 57%. These hyperscalers are basically taking half of their massive revenues and plowing it right back into physical infrastructure. They're acting way less like traditional software businesses and honestly much more like heavy industrial companies or utility providers. Moving right along to part 2, big tech's massive AI bets. Take a look at how concentrated the spending is. Amazon is projected to spend over $125 billion, hitting a jaw-dropping 57% capital intensity. And that's mostly driven by AWS AI. Microsoft, they're crossing the $100 billion mark for Azure AI. Google is also well over $100 billion for its TPU and GPU expansions. Meta has essentially doubled its 2024 spending to reach nearly $100 billion as well. And then Oracle rounds out the top 5 at about $20 billion. So 4 out of these 5 companies are now individually crossing the $100 billion annual spending mark. It's just a completely historic arms race. Which brings us to part 3, where the money actually goes. So what are they actually buying with all this cash? Now, you might think this is just going toward general cloud upgrades, but it's not. 75% of this massive 2026 budget, a staggering $450 billion, is entirely dedicated to AI infrastructure. Only 15% goes to traditional cloud, and the remaining 10% goes to things like real estate and networking. This entire economic engine is being entirely custom-built for artificial intelligence. Let's break open that $450 billion chunk line by line. The lion's share, about $180 billion, is flowing directly into GPUs and accelerators, with roughly 90% of that being captured by NVIDIA alone. The next biggest piece is $120 billion going straight into the physical construction of data centers. From there, you've got $50 billion for networking, $40 billion for advanced memory chips, $25 billion literally just to keep these massive machines cool, and $20 billion for power infrastructure. And we really need to translate those dollar figures into physical reality, because the scale is almost hard to comprehend. That $180 billion, that means they are buying roughly 6 million GPUs at an average price of $30,000 each. That $120 billion in construction translates to over 500 brand new data center facilities being built globally, basically compressing a standard 4-year pipeline into just 2 years. And the power? Oh man, this infrastructure requires 15 to 20 gigawatts of new capacity. To put that into perspective, that is the power equivalent of building roughly 15 nuclear power plants. All right, part 4, financing the debt wave. All of this physical construction leads us to the most absolutely crucial finding of this entire audit. How on earth are they paying for this? Well, we're seeing a monumental pivot. Historically, tech growth was funded internally by free cash flow. These companies made so much profit they could just pay for their own expansion in cash. But the AI build-out is so utterly massive that capital expenditures have officially outpaced internal cash generation. As a result, these historically cash-rich tech titans are now increasingly forced to tap debt markets to fund their AI ambitions. And to prove the sheer scale of this shift, just look at this data from Oliver Wyman. It shows investment-grade bond issuance by major AI players absolutely exploding. In just the last 6 months of 2025, bond issuance surged to $108 billion. That is more than 5 times the issuance of the prior 2 years combined. The tech sector is quite literally levering up at breakneck speed. But here's the kicker. Traditional bond markets actually aren't enough to cover this. Enter the shadow financiers. We are currently looking at what's called a private credit funding gap. The Oliver Wyman report flags that over $1 trillion of AI infrastructure debt is expected to come from private credit markets. These are non-bank lenders operating outside the traditional, heavily regulated banking system. Overall, JP Morgan estimates that over $1.5 trillion in total tech debt issuance is going to be needed over the coming years. So let me explain exactly how this private credit debt financing piece works. First, the required CapEx for these data centers drastically exceeds what the hyperscaler wants to pull from its own free cash flow. Second, rather than putting massive new debt directly on their public balance sheets, this debt is often routed through really opaque off-balance sheet structures. Finally, they construct incredibly complex deals, like Meta's recent $27.2 billion financing with private credit firm Blue Owl. These deals combine aspects of real estate, digital infrastructure, asset-backed securities, and alternative credit. Essentially, the financial risk is being quietly shifted away from the tech titans' balance sheets and hidden deep within the private credit market. Which brings us to this incredibly sobering quote directly from the Oliver Wyman report. An increasing share of this investment is debt-financed, much of it in off-balance sheet vehicles remote from cash-rich tech titans. Financial markets and the real economy are increasingly a naked bet on the future of AI. I really want you to think about that framing, a naked bet. This isn't just organic growth anymore, folks. It is a highly leveraged gamble on the long-term, completely unproven payoff of artificial intelligence. And that leads us to our final section, Part 5, the systemic risk ahead. So what exactly happens when you combine historic capital spending, shadow debt, and a highly concentrated technology bet? Well, we are already starting to see the first cracks. 40 basis points. That is how much credit spreads on AI-linked bonds have already widened compared to standard investment-grade bonds since just September. In plain English, widening spreads mean investors are demanding more yield, more payout, to hold this debt because they perceive higher risk. It's a very clear, early signal of investor anxiety over this massive, concentrated debt load. And you know, that risk isn't just contained to the private credit world. Today, the U.S. equity market capitalization is nearly double the actual U.S. economic growth, or GDP. That is a steeper divergence than we saw at the absolute peak of the dot-com bubble. Valuations of the Magnificent Seven tech titans have increased nearly 8-fold since 2020. An equity crash returning to historical norms could wipe out $33 trillion in value. That's more than the entire U.S. GDP, triggering massive drops in consumption and employment. This leads analysts straight to the 2008 contagion parallel. Think back to the financial crisis. Banks suddenly woke up and discovered they owned way more toxic, off-balance sheet housing risk than they realized, all because of opaque linkages. Fast forward to today. Instead of housing risk, financial markets might soon discover massive hidden exposures to digital infrastructure, GPUs, and data center debt, all spread out across corporate, real estate, and alternative credit books. Which leaves us with the ultimate question. If $600 billion of highly concentrated, increasingly leveraged spending is our new normal baseline, what happens if the AI bubble bursts? What happens if the massive revenue required to service this $1.5 trillion debt wave just doesn't materialize in time? Are we watching the creation of a sustainable technological supercycle, or are we looking at a ticking time bomb buried in private credit? I want you to think critically about where this money is coming from and where the risk is ultimately landing. To make sure you never miss an update on this rapidly evolving situation, hit subscribe and ring the bell. This explainer is just one part of MacroSignal's ongoing investigative series tracking global capital flows and the hyperscaler CapEx boom. We're going to be updating these numbers the second new data hits the market. Thank you so much for learning with us today, and we'll see you in the next explainer.